Too many people hit 65 with almost nothing left. They worked decades, raised kids, and dutifully saved, but a few quiet choices near retirement quietly ate away at their nest egg. Look at the neighbor who refinanced the house to help a child. They treated home equity like a safety net, and when an unexpected illness and a soft housing market arrived, selling or borrowing wiped out the last cushion. It often isn't that someone was reckless with money. A steady saver can still lose it all when retirement lines up with a deep market drop and they have to withdraw, turning temporary losses into permanent ones. There's one hidden pattern behind most empty retirement accounts. It's not just how much you saved, it's the timing and liquidity of your assets, and a misstep there can undo a lifetime of work. In the next few minutes, first I'll lay out the small, concrete choices that cause this to happen, and the practical shifts people made to stop it. Expect real examples, clear cause and effect, and the specific fixes that actually protect a retirement. The quiet erosion, small choices that add up. Small, repeated purchases quietly eat away at available cash over time. A daily coffee plus an extra streaming service and the occasional takeout meal add up in ways people rarely notice. Those little conveniences change lifestyle expectations, and then housing, transportation, and wardrobe choices creep upward to match. Once saving is sacrificed to maintain that standard, the habit usually persists and the margin for unexpected costs shrinks. Putting retirement savings on pause often feels like a harmless gap. Changing jobs, covering a sudden expense, or simply deciding later creates breaks in contribution patterns that are hard to repair. Missed contributions mean missed employer matches and fewer years of tax-advantaged growth, which multiplies the impact of each skipped paycheck deferral. When people cash out accounts on job changes or take loans against retirement plans for short-term needs, the loss compounding and potential penalties translate into much less available income decades later. Choosing cheaper insurance and deferring health maintenance can save money in the short run. Picking a high-deductible plan to lower premiums or skipping dental checkups seems practical until an illness or tooth infection requires emergency care. Those decisions force larger out-of-pocket payments and sometimes sell-down of assets to cover care, which directly reduces retirement resources. Not planning for long-term care or assuming family will cover it often results in rushed, costly solutions that erode savings. Not talking about money and avoiding simple legal steps creates a slow unraveling. Failing to name beneficiaries, delay in updating wills, or keeping financial information siloed leads to delays, probate costs, and sometimes the need to liquidate property quickly. Small habits like ignoring bills, relying on credit cards for temporary shortfalls, or delaying a budget review tend to compound into interest and fees that reduce net worth. Those quiet, everyday choices don't scream when they happen, but together they reshape the options people have after 65. When systems stack against you, pensions, healthcare, and work, employer pensions no longer provide the steady income many people counted on. Companies moved away from guaranteed plans and toward accounts that put investment decisions in the workers' hands, so market swings now directly affect someone's retirement. Someone who left a series of part-time retail jobs with small 401k balances often finds money spread across cash-outs and old accounts that sit uninvested. The consequence is that retirement income becomes volatile and tied to moments of job loss or market drops, not to steady, predictable paychecks. Healthcare eats into whatever nest egg someone has faster than most expect. Medicare and similar public programs cover a lot, but they leave gaps. Things like long-term custodial care, dental, hearing, and many outpatient expenses often come out of pocket. A retired school bus driver with arthritis may be able to get doctor visits covered, but still face big bills for a home aid or rehabilitation that insurance won't fully pick up. Those out-of-pocket hits force people to spend down savings quickly, and that spending is permanent. Work is less linear and more precarious now, and that changes who collects what later. Gig or contract work usually means no employer contributions, and part-time schedules can make someone ineligible for benefits they would have had if they worked full-time. A caregiver who leaves a steady job to look after an aging parent loses years of pension vesting and missed the chance to build retirement savings during prime earning years. That interrupted income history shrinks Social Security credits and employer-based accruals, creating a hole that's hard to fill later. Policies and paperwork amplify small problems into life-changing shortfalls. Vesting rules, minimum service requirements, and pension freezes can convert a few years out of the labor force into a lifetime of reduced benefits. Add high deductibles and copays and the math gets worse. Picture a factory worker laid off in midlife who takes a series of short-term gigs, cashes out a 401k to cover rent, and later develops diabetes. Each decision and each policy limit multiplies, leaving little left at age 65. Behavior and design combine to lock people out of security. Complexity makes it easy to default into bad choices, like refusing auto-enrollment or taking early withdrawals to cover emergencies, and the systems rarely correct those mistakes. When employer sponsorship is patchy, healthcare coverage is partial, and jobs are unstable, the result is predictable. Many arrive at retirement with much less than they assumed, and for some, effectively nothing. Life's curveballs: illness, divorce, and caregiving costs. Serious illness often means more than hospital bills. It strips away steady paychecks and eats into emergency funds. People on fixed incomes face high out-of-pocket costs even with insurance, because plans rarely cover everything. Think copays, specialist visits, prescriptions not on formulary, travel for treatment, and the home modifications that make daily life possible. Medicare will pay for many medical services, but it does not cover long-term custodial care in a nursing home or full-time personal care at home, and that gap forces families to tap retirement savings or sell assets. When a partner leaves, finances shift overnight. Divorce after decades together splits retirement accounts, doubles housing costs for two households, and often reduces future social security benefits for one or both people. A 401k or pension that supported a single household can suddenly be divided, and transaction costs and taxes take bites out of proceeds. People who thought joint health insurance or shared mortgage payments would last often find themselves paying much more to recreate a stable life on a smaller pot of savings. Taking on the role of caregiver changes income trajectories in concrete ways. A spouse who cuts hours to provide care loses not only wages but future raises and employer retirement contributions. Hiring a caregiver, even part-time, can cost an amount that erodes a modest nest egg quickly. Families also face hidden expenses like transportation, legal paperwork, and incidental medical supplies, plus the emotional burnout that can force someone to quit work entirely. Public programs can help in limited scenarios, but eligibility rules and waiting lists mean many families pay out of pocket in the meantime. These shocks often cascade rather than occur alone. An illness can lead to caregiving, which can strain a marriage and trigger divorce, and each step multiplies costs while shrinking resources. In one common scenario, a caregiver leaves a job to look after a spouse, sells a larger home to afford caregiving and reduce upkeep, and then faces divorce negotiations that divide the remaining assets, leaving both people with far less than planned for retirement. Small, concrete choices made under stress translate directly into long-term shortfalls, exhausted savings, reduced income, and limited options for paid care later on. The psychology of decline: shame, denial, and short-term fixes. People often shrink away from money problems the way they shrink away from bad news. Shame makes them hide unpaid bills, avoid the mailbox, and stop answering calls from unknown numbers. When that happens, late fees pile on, creditors escalate contact, and what started as one missed payment becomes a cascade of penalties and damaged credit. A retired teacher who quietly stopped opening statements after her partner died might think she's preserving dignity, but the effect is very concrete: missed appeals, unpaid taxes, and eventually an emergency that wipes out savings. Denial shows up as a refusal to update plans or to admit loss. It is a psychological plug that keeps unpleasant realities out of conscious thought. Because of that denial, people delay talking to a financial advisor, avoid applying for benefits they qualify for, or keep paying a mortgage on a house they can't maintain. A man who keeps a big family home for sentimental reasons but can't afford repairs ends up selling under pressure, often accepting a low offer because deferred maintenance turned into a crisis. Quick fixes feel like rescue, and that immediate relief usually silences the shame for a little while. Short-term solutions: high-interest payday loans, maxed-out credit cards, cashing out retirement accounts, or taking a reverse mortgage, give money now. But those options carry steep costs. A woman who pawned heirloom jewelry to pay a hospital bill had cash the next day. Months later, she lacked both the family legacy and enough cushion to cover a new expense. Pride and identity make the psychology worse. Many people equate financial independence with self-worth, so asking adult children for help or admitting a mistake feels like a loss of identity. That dynamic changes family interactions. Kids notice unopened envelopes and repeated overdrafts, then get pushed away by sharp refusals or emotional withdrawal. The result is lonely crisis management, where friends and relatives are kept at arm's length until a breakdown forces a hurried and costly solution. Professionals spot a pattern: avoidance, quick fixes, and then emergency liquidation. Social workers, case managers, and some bankers describe clients who were reluctant to discuss options until a neutral third person reframed consequences in plain terms. One counselor recalled walking through scenarios with a retired factory worker who'd taken an expensive cash loan. After seeing how fees would compound, he opted for a cheaper arrangement with help from a community program. The takeaway is visible in everyday signs: unopened mail, sudden sales of valuables, repeated short-term borrowing, and in the real effects these behaviors have on long-term security. Fixable leaks, practical steps to reclaim stability. Small, regular withdrawals from the account often look harmless until they aren't. A handful of low-cost subscriptions, auto-pays for convenience services, gym apps you never open, they add up and quietly erode monthly cash flow, leaving less available to save or cover unexpected bills. Listing every recurring charge exposes the pattern. The cause is inertia, and the effect is fewer buffer months when something goes wrong. One retiree discovered 3 streaming services and 2 meal kit plans he'd forgotten about, and switching to a single shared account covered his phone bill for a year. Interest on unsecured debt behaves like a leak with a weight attached. Carrying a credit card balance month after month means interest accelerates the debt faster than small payments reduce it, which in turn eats into any money that could have gone into savings. Looking at options can change the flow, moving balances to lower-rate products, consolidating multiple debts into a single payment, or working with a non-profit credit counselor can reduce interest drag and free up cash for emergencies. For example, a woman making only minimum payments on 2 cards found that consolidating into one lower-rate loan turned a crisis of payments into a steady, predictable plan. Housing-related costs are often the biggest single drain for older households. Owning a larger home than needed means higher property taxes, maintenance bills, heating costs, and occasional surprise repairs, and those ongoing expenses can consume money that might otherwise build retirement stability. Creative changes shift the balance. Renting out a room, moving to a smaller place, or refinancing a mortgage can reduce monthly outlays and increase disposable income. A man on a fixed pension rented his basement to a tenant and discovered the extra rent covered his property tax and a portion of his utilities, making the rest of his income stretch further. Healthcare expenses feel unavoidable, and overlap in coverage or unnecessary premiums create avoidable leaks. Paying separately for 2 plans with similar benefits, not reviewing prescription drug formularies, or failing to switch to therapeutically equivalent generic medicines can quietly raise monthly costs. Careful review of coverage details and shopping for the best fit plans limits those outflows, and asking a pharmacist about generic alternatives or manufacturer coupons can reduce drug costs. One retired teacher who compared formularies saved enough on prescriptions to cover a portion of her dental expenses that year. Small income boosts and automated habits plug many of the remaining gaps. Inertia often means missed benefits, unclaimed employer retirement perks, or forgotten catch-up contribution opportunities that would have quietly increased long-term stability. Regular small inflows, a few hours of tutoring, seasonal consulting, or selling unused equipment, plus automatic transfers into a savings or emergency account change the math without dramatic lifestyle upheaval. A retired graphic designer who set aside a fixed portion of occasional freelance payments into an auto-deposit emergency fund found she could absorb 2 months of unexpected expenses without borrowing. You've probably seen people retire with a great plan and then end up with very little. In short, it's rarely one catastrophe. It's the slow squeeze of small choices and bad timing mixing with big shocks, like taking benefits early, dipping into retirement accounts, surprise medical bills, and gradual lifestyle creep that together eat away at savings. Those forces stack until there's almost nothing left. It feels unfair when someone follows the rules and still runs out. Think of the couple who claimed Social Security at 62 to patch a shortfall, then faced a major home repair and a long illness, and watched their safety net unravel faster than they could rebuild it. Timing matters because those early decisions change how much room you have to recover. Maybe this hits close to home. For example, skipping an employer match for years to cover monthly expenses, then losing a job at 58, forces withdrawals and creates a sequence that's hard to reverse. Each withdrawal lowers future growth and increases vulnerability to the next emergency. Small choices early become big consequences later. Worry is useful. It makes you pay attention. If you'd like more stories and practical breakdowns that show how these patterns play out in real lives, consider subscribing so you catch future episodes, a simple way to keep following the thread without any hype. No hard sell, just more real cases and clear thinking. There's more we can unpack together. Next time we'll walk through simple pivots, small habit changes, safety net ideas, and timing adjustments that help people in their 70s and 80s avoid empty pockets, with concrete before and after examples so you can see what actually moved the needle. We'll keep it practical.